Hi to all. So in this a quick video, we will continue to work with matrix operations. This one doesn't look that complicated. It's actually the formula matrix form to get the weights that correspond to the optimal risky portfolio or tangency portfolio. And what is that? Okay, so once again, we're looking at some hypothetical scenario to sort of understand things in a more intuitive way. You have a high net worth individual who is interested in maximizing the reward for each unit of risk that the fund is going to be tolerating, and that is Sharpe ratio, and more specifically, the excess reward or excess return or additional units of return in a on beyond riskless rate. Okay, there's a whole theory behind this, but in this video, I'm gonna focus on the matrix operation, which is what we are trying to um, sort of acquaint with. So here we have some data. Let's plot this data in these matrices, okay? We have the covariance matrix. Once again, if we had 10 assets, this would be a 10 by 10. And once again, you don't need to type manually the values. Excel could generate it if you have the time series there, or you could get that covariance matrix from any statistical software, like even like something like Python would help you to get that matrix right away. So you have the standard deviation of the bond is 6%, sigma of bonds is 6%. That means that 0.06 squared, the square of the standard deviation is the variance of bonds, and the standard deviation of stocks is 15%. So that is 0.15 squared. Then here we have 0.0225 as the variance for equity, and then the covariance is essentially 0.003. Okay, 0.003, and we have it here 0.003. We don't need to write this again. The covariance of equity and bonds is the same as the covariance of bonds and equity. The order doesn't make any difference. So these two cells are the same. Now, let us quickly use solver once again just to confirm that our answers are correct. Okay, and let's begin with some random hypothetical weights of 50%, 50%, and then the sum of these weights is 100%. We have a returns matrix, and the returns matrix is 4% bonds, 10% for equity. The expected return from the bond allocation is 4%. The expected return for equities in this hypothetical world is 10%. Okay, and once again, we will have a matrix full of ones. The ones matrix, which is a vector of a matrix of n by one column, n number of rows. Now we're gonna call this one mu RF. And mu RF is the returns minus the risk-free rate that let's have it here. Okay, now let's assume that the risk-free rate is 0.5%. Okay, and we can write this later. And so the mu RF is just returns minus risk-free rate. The idea, but there's a whole theory behind it. We're not going to discuss it too much, but the whole idea here is that we are interested in units of return beyond the treasuries, and that's the only thing we care. So if there is a risky portfolio giving me 0.5%, I'm not interested about that. I can invest in riskless investments and still get that return. I'm only interested in a return, a level of return that is above that 0.5%. Okay. Okay, so then we just do this. And now in this case, let us calculate a couple of things like the variance. If you are not familiar with these steps, you can watch previous videos. We have been doing this. So for the variance, we're going to use M transpose. And before we even use these formulas, let's give this matrices names because that makes everything much easier. So this is the covariance matrix. I'm calling it COV. This is the weight matrix. I'm calling it W. Now this, I'm gonna call it red one. We're not using this one in this particular problem. This one we're calling it RET. This one we're calling it mu RF. Okay, this cell we call it RF. And now we can work here with the variance and molt. If you are not familiar with this formula, once again, you can go back to the first video covering the variance and the minimum variance of allocation. And I go over this in detail, but it's just M molt, and then we're multiplying the transpose of W. So essentially we're doing W covariance W. Because of matrix dimensions, we need to transpose W to ensure that this can be multiplied. And then we multiply first transpose of W and cov, and the output of that we multiply it then with W. And there we go. This is the variance, and this the square root of the variance. That is the standard deviation. What about the return of a portfolio? We can use two approaches, M molt of transpose of W, comma, ret, transpose of W. After we transpose W, then comma, ret. But we could also have done some product of W and ret. Okay, in the case of returns, that works. In the case of variance, we need that matrix multiplication operation. Now, if we want to find the optimal risky portfolio, it's the portfolio that gives us the highest ratio of excess return, that is returns beyond the risk-free rate, to as a ratio of the units of risk that I have to tolerate to get that excess return. Okay, so I believe I have a nice, I have matrix formula here, but the Sharpe ratio is just the return of a portfolio minus the risk-free rate. So the excess return, that would be the expected if we are evaluating that with a forward-looking uh, perspective, and then divided by the standard deviation. Okay, so then we once again excess return I'm expecting beyond risk-free rate, but then that has a cost, and that ratio I want to maximize it. So if I just use solver, I can do, let me calculate the Sharpe ratio somewhere here. I didn't have it before, but we can do it. Sharpe, so the Sharpe ratio of this portfolio would be the return of a portfolio minus the risk-free rate here, RF, I named this cell, divided by the standard deviation. So that is the Sharpe ratio is not a percentage, but it's more like a decimal, multiple. So in other words, I am getting 0.73 units of excess return for each unit of risk I am tolerating in this, and this is the Sharpe ratio of this particular allocation where I have equal weights on equity and bonds. Let's use solver, data, solver. And now let's find the solution that we get from solver, and then we can use the matrix operation. So our objective function in this case is the Sharpe. So we go here. And in this case, we want to maximize it. So we're asking Excel, please evaluate this formula a very large number of times, but every single time you're going to change the weights and you're going to explore different weight combinations. So you're going to change W. So if we just move here, you're going to change these weights, W, every single time. And then once you have done those iterations, look at all the Sharpe ratios that you got and give me the allocation, the combination of weights that lead me to the highest Sharpe ratio. There is one condition, which is this has to be equal to 1. In other words, if I'm investing 1 million, you have to invest everything, so the weights have to add up to 1. Okay, let me remove this condition, which is that the weights can only be positive. If you check this box, then all the weights are always positive. Let me remove that condition, and then we can solve, and Excel found the solution. And there we go. The weights are 32.05 for equity and 67.95 for bonds. The Sharpe ratio we get is 0.75. That is the highest possible Sharpe ratio we can get. Now, the Sharpe ratio depends on RF. So needless to say, if RF, let's say if we had an RF of 0, this Sharpe ratio would be higher. But if the risk-free rate, if interest rates go up to 1%, this Sharpe ratio also goes down. So the Sharpe ratio changes the it changes the sharp the risk-free rate. The interest rate changes in interest rates are going to change the Sharpe ratio. I think that's a pretty obvious and straightforward to see. Now let's copy these values here. 32.05%, 67.95%, and then these are solver solutions. We are only having those there to confirm that the solutions we get using matrix multiplications are going to match. Okay, now this specific problem, we can do it in two steps. And this one, luckily, it's actually not that difficult. It's actually, to some extent, a straightforward approach. So let's do it in two steps. Okay, the first step here, let's type the matrix formula, which is going to be M mult. We only multiply two things in the numerator, so I only need one M mult. And the first item in that multiplication is M inverse of the covariance matrix, comma, mu RF. And what is mu RF? Mu RF is this matrix where I have the same values I'm listing here in the returns matrix, but to each one of the expected returns of each one of the asset classes, I am subtracting the risk, the current, the latest, the most recent risk-free rate. In other words, okay, equity is giving me a 10%. To this investor, in my view, if I'm maximizing Sharpe ratio, I don't care about the first 0.5%. I only care about the 9.5% I am getting beyond the 0.5%. Okay. And I am only going to tolerate risk for a level of return that is higher beyond this risk-free rate. Okay, so that is mu RF. If we go back here, we are typing some formula. Then that's it for the numerator. The denominator, if you recall one of the videos before, we had a similar situation. The denominator is identical to the numerator, but then we're multiplying by a vector of 1. So effectively, we are simply adding up these values. So the denominator is the sum of these values. So rather than using matrix, we can also do this. We can do sum of these. I mean, if we use matrix, that's okay. We can use matrix M mult, transpose of ones, okay, comma, M inverse of covariance, close the first multiplication, mu RF, close the second multiplication. Let me see if I missed M mult. Then we have transpose of ones. And I am missing ones. So let's go there. And let's give this a name, ones. Okay, and now bottom line, the denominator in matrix form, it's simply because it's the same but multiplied by one, it's simply the summation of these values. And these values, I am getting them with the numerator formula. And now we just divide the numerator by the denominator. Okay, so in this case, okay, we just added them up. Numerator divided by the denominator, numerator divided by the denominator. I mean, you could also divide this new matrix by this scalar, and you get the two values, 32, 67, and that is exactly the same we already have here. Okay, so this is a two-step approach you can follow. Okay, so this is the numerator. Okay, numerator. And then there we go. And now this is the denominator. Okay, and then these are the weights. These are this is the solution. Okay, so you can do that, but you can also add all of that in a formula uh, at once. So you can go here, and then you can simply do m mod, only one m mod, and you have m inverse of covariance, and then formula. We're just following this formula. Okay, so mu RF, and then this is the denominator, and we're done. I wanted to show this formula. There is a resemblance. If you look at the global minimum variance formula, we used a couple of videos before. It is the same. That's why we're sort of doing this little drill again, because the formula is it looks quite similar. The difference is that instead of mu RF, you have a vector of ones and a vector of ones to the right of the covariance inverse in the numerator, and to the right of the covariance inverse in the denominator. This would be a vector of ones and a vector of ones. So the denominator would be 1 transpose omega inverse ones, and the numerator would be inverse of omega times ones, the matrix. So essentially now this is very similar, but you're using mu RF, okay? And mu RF is this matrix. So you have M inverse of covariance, mu RF, divided by, and then you have a mod transpose of ones, comma, covariance, comma, mu RF. And then there we go. And okay, transpose of ones times, and of course here, let's keep in mind that this is not just simply covariance, but it should be M inverse, the inverse of the covariance. So I completely forgot the inverse. We just add the inverse here, and now we have exactly the same weights here. That was just to be careful when typing these formulas and not forget these details. 32.05 and 67.95, but in this case we are using this particular matrix formation. So there we go. I mean, if we want to program more complicated problems and evaluate multiple solutions, if we are changing any of these parameters, then the approach, a solver approach, would be tedious, because you would need to solve one time and again and again and again, one by one. You would need to bring the solver every time you are evaluating a different parameter. But if you're programming in Excel, or I mean, I'm calling programming, but it would be like typing some formulas in Excel to evaluate an array of solutions, then the matrix form allows us to do this much more effectively. Okay, so I hope this video was helpful, and thanks once again for all the attention. Just to wrap up, we have solved multiple different problems, and using matrix operations. One of the first problems we solved was finding a portfolio giving us the lowest possible risk, or the combination of weights leading us to the lowest possible risk. But then once we got those matrices and those weights, we were also calculating, okay, what is the level of risk? So what is the variance? What is the standard deviation? What is the level of return? And we also got the portfolio with the lowest level of risk conditional to a return goal. And finally, we are also solving for the portfolio that has the highest Sharpe ratio, which in portfolio theory, it is essentially the optimal risky portfolio or the tangency portfolio. Okay, and then because it is the portfolio, you could identify this portfolio with solver. You can identify this portfolio with these formulas. You can identify this portfolio using the formula, but in a simpler way, two-step if you prefer so. But you could also identify this portfolio if you draw a chart and then you draw a tangent that goes from the risk-free rate to this and touches the efficient frontier that we drew in one of the previous videos too. That line intersects the point at which this tangent line intersects the efficient frontier. That point is precisely the coordinates set by the risk and return of the optimal risky portfolio that we are getting here, and the weights are 32% and 68%. Okay, so once again, thanks for your attention, and if please feel free to contact me if you have any doubts, any questions. Thanks for your attention. Let's keep in touch.